Big tech continues to power the markets. The NASDAQ, the Russell 2000 index, sitting at record highs, and the S&P is not far behind. Joining us right now is the Chief Investment Officer at Federated Investors, which is $315 billion in assets under management. Stephen Auth is with us. Stephen, good to see you. Thanks so much for joining us.
Thanks for having me.
You're fully invested here.
We're pretty close, yeah. We think the market's heading higher. The consensus really is that we're going to roll over as we approach the peak from back in early January. And I think people think we're late cycle, market's expensive. We think we're not late cycle. We don't think the market's expensive. And we're heading in an earnings season. It's probably going to be the best earnings season in almost a decade.
We just came off of a great earnings season, too.
And this one's even going to be better. You know, earnings are going to be up about 20%. And we're only weeks away now, and I think that's the next focus of the market. And I think once we power through the January highs, technically, you could have the market head considerably higher.
And Steve, you pointed out that a lot of people are again, not bullish this market. They're giving a lot of reasons why the market should roll over here. And having been through 2000 and been through 2008, prior to those two periods, you had everybody sell your house, invest in the market.
Right.
Everybody was uber bullish.
Yeah.
Whereas now, I feel like the consensus is very negative, which I think is a great opportunity for the market because the earnings are really showing real growth in certain sectors.
Yeah, it's really funny. We got this great fundamental backdrop, yet the overall consensus is very cautious. I put out a piece a couple of weeks ago called The 5 Myths. And to me, talking to a lot of investors, there's these beliefs that what goes up must come down, that we're late cycle, that the market's overexpensive. And it's just, we're not late cycle. If you look at where we are, the expansion, the average expansion in this cycle per year is about 2.1%, whereas most economic expansions would be more than double that. You could argue, in time it's been long, but in distance it hasn't been.
Mm-hmm. But the age of it, like we're on our 10th year.
Yeah,
right
people
now,
are worried about the age.
That's what they keep bringing up. Yeah, that's what the skeptics bring up.
Okay,
but I think age is potentially a good thing.
Age is just a number.
Absolutely. And, whatever you are is the new 30. But right. I'm wondering with the stocks, you're saying they're not expensive. So I think traditional analysis, you look at trailing earnings and you say, wow, that's expensive. You look at forward earnings, it looks kind of reasonable. Is there a specific yardstick you use to say stocks are cheap, stocks are not cheap?
Well, our yardstick is we look forward. We try to analyze the fundamentals and where we're heading. And people have been saying this market's expensive all the way up. And it's mostly because they're looking at trailing numbers. But on a forward basis, this market is not expensive. And on individual stocks, it's not expensive. I mean, there's some of the stocks we like. You mentioned some of the tech stocks, like Facebook as an example. It's a great growth compounder. Yeah. Stocks trading, 24 times next year's earnings. That's not expensive, particularly with
not compared to Amazon.
Probably understated. Yeah, not compared to Amazon. Apple's, 16 times. JP Morgan stock we like. It's trading at 13 times.
Wait, why do you say Facebook's earnings are understated? What does that mean?
Well, if you look at the traditional accounting in this country is based on widget production, basically, right? So when you invest in a factory, you get to expense that over 2 decades. But if you're investing in tech and data, it's immediate expensed. But there's assets on the balance sheets of companies like Facebook that are not even on the balance. They're off balance sheet.
Well, they're not monetizing WhatsApp. They're not monetizing the Messenger.
All this data has enormous value, and it's not shown up on the balance sheet. It's already been expensed, in effect. The acquisition of it hasn't been. So, if you look on a cash flow basis, these companies are generating enormous amounts of cash flow.
How much harder is your job right now because the velocity of change with new technology coming out? You have a company going from a startup early stage company to a multi-billion-dollar company in a couple of years. Does that make your job in analyzing and valuing these companies that much harder?
I think, in general, investing in stocks has become more and more difficult at the same time that more and more investors have just gone passive. And that's what creates the great opportunity for the active manager. And, active managers have now been outperforming the last 12 to 18 months. There's so much money in the market that just is blindly investing. In some ways, it makes our job a little bit easier, in effect. But yeah, I mean, is the complexity high? That's what you're exploring on the show every morning. It's gotten more and more complex.
Yeah.
It's a complex world.
But even looking back 10 years, are investors still shaken from the financial crisis and overinvested in fixed income, thinking that fixed income, particularly treasuries, longer-term treasuries, are some sort of haven? Is that the real concern here?
Right, I think...
Because, again, we're staring at a bear market for something, right?
Right.
It's either it's going to be equities or fixed income.
You're half full, half empty, but I would say that the half full element here, and one of our theses for what we call the secular bull, we think we're in this long cycle secular bull, is just that the base of this expansion is the worst economic crisis since really the Great Depression. And every economic actor out there has been negatively affected by this. And they all think sooner or later it's going to roll over, even the regulators. So they've been very kind to this market as a result. So when everyone's expecting something to happen, that usually doesn't happen. And that's why stocks, we think, are still undervalued. Is there a bubble in bonds? We're not a believer of that. We think bond yields are low for a reason, and we think they're going to grind higher, but we don't anticipate and certainly if we had a big sell-off in bonds, that would hurt equities for sure.
Let me ask you, the Federal Reserve meeting next week, you're expecting the Fed to raise interest rates?
Well, me and everyone else.
And everybody else. Okay, but let's just talk about this for a second, because during the break we were talking about and noticing some of these price increases. The price of coffee, Starbucks coffee's going up, airline tickets are going up. What else did we say? Gasoline prices are going up. Is inflation an issue? How does the Fed deal with that? And what does the market do as rates start going higher?
So some things are going up, but there's an awful lot of stuff not going up. Price of diapers isn't going up. Most staples, the prices are not going up, right? There's not a lot of pricing power. And you've got the Amazon effect out there, literally with a Gatling gun on top of the mountaintop, waiting for anyone to volunteer their hand to raise a price.
But I'll throw it at you this way. Maybe consumers aren't getting those price increases passed along, that inflation, but it is hitting businesses. Steel prices, even before these tariffs go into effect, are up 40% in the United States year to date, or were through the end of last week, even more year over year. You have freight costs going up, and Cisco, the food company, saying our costs have gone up. We can't pass them on to our customers. That hits profit margins. So is that a concern if you own stocks?
We're about to produce a 20% year-over-year quarterly gains in earnings in the upcoming quarter. So yes, cost pressures are affecting some companies, and active investors like us, we're very carefully watching which companies don't have enough pricing power or aren't. But there's other ways to offset commodity price increases. You get productivity. You get a corporate tax cut, and maybe use some of that money to pay your workers